I have an ambitious agenda today. I want to cover what is a stock, losses, and what is a capital dividend account and how does it work. So we've talked about what a stock is before. A stock is an ownership stake in a company. So when you buy shares of a company, you are basically saying, I believe in the future of this company. And just like we saw in the income versus growth video, some shares pay dividends. And if they don't pay dividends, in all likelihood, it's because the company is reinvesting its profits into its own operations to further its growth, which is great because when we buy shares of a company, we want those shares to grow. We want that growth to compound, and so that eventually, when we sell the shares, we generate a capital gain. Now, what is a capital gain? A capital gain is the difference between what you pay for the stock or the cost and the fair market value or the price of it when you sell. So remember we talked about integration? Integration is the idea that the same tax treatment for individuals should apply to corporations. And so this is where the CDA or capital dividend account comes into play, because corporations have capital dividend accounts to replicate this capital gain treatment where half of it is not taxable. Right now, there are talks of increasing that, but right now 50% of every capital gain is included in your income. And so for a corporation, 50% of every capital gain goes into their CDA. Now, in a year like we've had this year, where we see a lot of volatility, it's possible that the price of the stock or the fair market value of the stock today is actually lower than what we paid for it or lower than its cost. And in that case, if we sell it, if we have to sell it or we choose to, we generate a capital loss. Now, losses can be interesting because they reduce your income. Just like a gain gets added to your income, losses reduce it, which means less tax to pay. And if you can't use it this year, you can actually carry it back 3 years or carry it forward indefinitely. And when the same treatment applies to CDAs for corporations. So whereas the capital dividend account gets increased by gains, it gets reduced by losses. So it's possible that, given that we're approaching the end of the year for individuals, we might be, as investors, or when you talk to your accountant, you might think about taking losses if there are in your portfolio. Now, if you're a corporation and your fiscal year is also December 31st, just be aware that if you are going to take losses, they will reduce your CDA balance. And so you may want to elect or choose to take your capital dividend, which is not taxable, before you take those losses and before that amount gets reduced. Thanks. Have a great day. And please don't hesitate to send questions or feedback.